Every day here on the Deep Dive, we drill down into these seismic shifts moving the financial world. And, well, today we have it. We have quantitative confirmation of a structural change that is, I think, fundamentally redefining the digital asset ecosystem.
It really is. This isn't about vague speculation anymore.
Yeah.
It's just about the market mechanics. It's verifiable capital deployment.
And if you had to pick one data point, just one thing to anchor our understanding of the market right now, where would you start?
You have to look at the institutional flows, specifically into the U.S. spot Bitcoin ETFs from last Friday.
Yeah.
We saw a mind-boggling $697.2 million net inflow.
Almost $700 million in a single trading session.
Yeah. That is statistically momentous. To give you some context, that's the largest single-day inflow we've recorded since October of 2025.
Wow.
And a capital movement of that scale, it confirms the whole narrative we've been watching, right? This synchronization of flow and infrastructure. The rails are in place, and now the money's really starting to move.
That's the key. The money is moving. And it suggests that institutional capital is rotating pretty aggressively, I'd say, into digital scarcity. And it's doing it in a way that seems to be decoupling Bitcoin from those, traditional risk-off correlations we used to track so closely.
Exactly.
So our mission today is to distill the real drivers. Who is moving this money, and why is this shift so structural? Why isn't it just speculative noise? Okay, let's unpack this.
I think we have to start with that institutional liquidity catalyst. That $697 million, that's not retail traders on some forum.
No.
It's systematic, volume-weighted execution by the big allocators. You're talking registered investment advisors, hedge funds, pension funds, and they're clearly front-running the monetary easing we're all expecting later in 2026.
Let's pause on that phrase you used, volume-weighted execution. For our listeners, is that just institutional slang for being careful not to move the market too much?
That's pretty much it, yes. It means they were deliberate. They're sophisticated buyers using algorithms to, spread their orders throughout the day, get the best possible average price. This isn't emotional FOMO buying. It's mandated allocation.
And when you look inside the ETFs, the breakdown is also really telling. It's a flight to quality.
Absolutely. BlackRock's IBIT just dominated the inflows. It absorbed, $372.5 million alone?
And Fidelity's FBTC, which has that huge RIA and retail base, it was right there behind them. A massive 191 million plus.
But here's the real structural shift. The thing that allowed those flows to translate directly into price appreciation. Grayscale.
Let me guess. Zero flows.
Zero flows for the day. And the absence of outflows from GBTC, that's just as bullish as the inflows to BlackRock.
Okay, I agree. The selling pressure stopping is a huge deal, but zero is still neutral, isn't it? Doesn't it just mean the arbitrage trade has kind of exhausted itself for now, and maybe there's a risk of it coming back if prices dip?
That's a fair point. But structurally, it means the natural buyers who were already there, they're no longer being canceled out by forced sellers.
So the net inflows can finally do their work.
They can translate cleanly into price discovery, which they did. And when you look at the raw math of the supply being consumed, the story just gets even clearer.
Okay, so let's quantify that supply squeeze. What does a nearly $700 million day actually remove from the market?
The demand multiplier is stark. A single day of institutional inflow removes roughly 7,500 BTC from the market. Now, you have to contrast that with how much is being produced.
Which is only about 450 BTC a day from the miners.
Right. So you're saying institutions just consume 16 days worth of new supply in one trading session.
Exactly. That's the math. You have the miners as this small faucet, and the ETFs are drinking from a fire hose. It creates a 16 times demand multiplier. 16 times.
And it's rapidly draining the exchange float, forcing the price higher. That one number, 16x, that's the clearest indicator of the structural imbalance right now.
And that dynamic alone is probably enough to justify the price action, but we also have this huge regulatory tailwind hitting. Tell us about the policy pivot at Bank of America.
This is monumental. This is a huge structural change. Bank of America has updated its wealth management policies.
Yeah.
So advisors at Merrill Lynch and their private bank, they are now officially permitted to recommend a 1 to 4% allocation to Bitcoin ETFs.
Okay, that word, recommend. That's the key difference, right? It's not just passively executing an order anymore. It's actively suggesting it.
It is. And it potentially opens the floodgates to BOE's staggering, $3 trillion plus in client assets.
Pretty chilly.
Even if just 1% of that moves over the next year, you're talking about tens of billions in new, sticky institutional inflows.
Yep.
This is mainstream endorsement.
So institutions are locked in, but they often follow the lead of the asset's biggest believers, which are the corporate treasuries. Let's talk about that because it's become a genuine corporate treasury arms race.
That's the perfect way to put it. MicroStrategy is still the benchmark, of course. They're just relentless. They just acquired another 12,286 BTC for about $116 million. Average price of $90,391.
And they're still funding it through those at-the-market equity sales, just essentially printing their own stock to buy Bitcoin. It's incredibly aggressive.
It is, and it's a strategy that keeps paying off for them. But the real action is getting even wilder further down the market cap scale. It's what we're calling treasury activism.
All right, tell us about hyperscale data. This is where the story gets really interesting.
Hyperscale data, or GPUS, is the best example of this new aggressive phase. They just made headlines because their Bitcoin treasury now exceeds 102% of its entire market cap.
Wait, 102%. So the Bitcoin they hold is worth more than their entire company's stock.
That's it. So their main driver for equity valuation isn't their operating business anymore. It's the Bitcoin they hold. They basically turned their public stock into a high beta Bitcoin investment vehicle.
And this whole phenomenon is made worse by what the miners are doing, right?
It's exacerbated by them, yeah.
Yeah.
Look at a company like Kango Inc. They produced 569 BTC in December, bringing their total to over 7,500. And crucially, they've confirmed they have no plans to sell,
So they're hoarding.
reinforcing that miner hoarding trend. So if new supply is held off the market and ETFs are buying 16 times that new supply, the squeeze just tightens exponentially.
The whole story just flows so perfectly. You have the relentless buyers, and then you have the infrastructure that enables them. Let's shift there now to the picks and shovels. That moment, Goldman Sachs upgraded Coinbase felt pivotal.
It was the structural thesis laid bare. Goldman explicitly pivoted their investment thesis away from just cyclical trading volumes.
Right, the old idea that Coinbase only makes money when the market is volatile.
Exactly. They've shifted toward structural infrastructure growth. They're basically saying this isn't a casino anymore. It's a diversified financial utility.
So where is that maturation actually coming from? What's the concrete evidence?
It's the revenue shift. It's undeniable. Services revenue, so that's custody fees, staking rewards, income from USDC, layer 2 fees from RISPs, that now accounts for about 40% of Coinbase's total revenue.
40%. Just 5 years ago, that was, what, less than 5%?
Barely. It confirms the whole model has matured. It's a robust financial utility now, and that warrants a higher valuation multiple, kind of like a SaaS company. That's what Wall Street is finally recognizing.
And that maturity signal isn't just with the exchanges. We're also seeing real innovation at the payment layer.
That's where you see someone like Tether step in. Their investment in a payments API startup called Square Isle. That's a direct play to get USDT into the last mile of global commerce.
So beyond just trading and settlement.
Way beyond. They're focused on QR code payments across Asia, Africa, Latin America. It's taking stablecoins and making them an actual medium of daily exchange for millions of people.
All right, so we have the institutional flow, the corporate motive, the maturing infrastructure. Let's translate that into the actual market structure. How is all this buying pressure showing up in the price action?
The action shows the market has transitioned. We're not testing supply anymore. We're aggressively defending support. We're seeing this consolidation right around 93,700.
Building a floor above that big psychological $92,000 level.
Exactly. It's building energy for the next leg up.
So give us the key levels you're tracking. What's the support floor that absolutely has to hold?
The key support is that RS flip, where the old resistance became the new support. That's the zone between 91,800 and 92,000. If the bulls defend that, the braid-out's integrity holds.
And what's the barrier they need to break to really get things moving?
The tactical battleground is that 94,500 to 95,000 zone. Order book data shows it's a known sell wall.
Why is 95,000 so important? Is it just a round number, or is there a mechanical reason?
Oh, it's intensely mechanical. It's all about the derivatives market. A sustained hourly close above 95K would almost certainly trigger a massive gamma squeeze on options dealers.
So 95K isn't just a hurdle, it's more like a coiled spring.
That's a perfect analogy. When the price moves above the strike prices where dealers are short calls, their risk models force them to buy spot Bitcoin immediately, to hedge. That frantic, forced buying is like a turbo engine, and it would likely propel the price very quickly towards 98,000.
And from a health check standpoint, is this rally getting overheated? Is the pace sustainable?
The momentum check looks strong. The daily RSI is at 66. I call it a Goldilocks reading. It's strong momentum, but with plenty of room to run before we hit technically overbought. And critically, leverage in the system is low. This rally is driven by spot buying. It's much healthier.
The final signal you pointed out is maybe the most important long-term one, the decoupling.
Yes, the correlation breakdown. We saw the geopolitical instability with Venezuela. Historically, an event like that would tie Bitcoin to gold, a risk-off move.
Right.
And while gold did rally, Bitcoin rallied harder. And crucially, it maintained its strong correlation with growth assets, with the Nasdaq. This confirms its new structural position.
Meaning it's no longer just digital gold.
It's trading as a risk-on store of value.
Yeah.
It gets the benefit of inflation hedging flows and the market's appetite for growth. That's a very powerful dual mandate.
Speaking of Venezuela, let's touch on that geopolitical elephant in the room. The alleged 600,000 plus BTC shadow reserve, that's still hanging over the market.
The market seems to be pricing in what's called the lockup thesis. The consensus is that if the U.S. government gets custody of those assets, they won't be liquidated quickly. They'll enter a multi-year legal limbo.
So whether the U.S. has them or Venezuela had them, the net effect is the same. Fewer available coins.
Precisely. It creates a sudden supply shock. You're effectively taking about 3% of the total Bitcoin supply from potentially liquid and moving it to illiquid. Supply is shrinking everywhere while demand surges.
And that institutional appetite, it's not just for Bitcoin, is it? We're seeing a pretty significant multi-chain bid now.
Oh yeah, the flows confirm ETH is being seen as its own distinct asset class. Spot Ethereum ETFs saw about 165 million in net inflows on Friday. BlackRock's ETH led with over 100 million of that.
It validates that whole thesis of Ethereum as like a yield-bearing internet bond.
Totally separate from the Bitcoin beta play. And that yield component just got a massive regulatory breakthrough.
The grayscale staking ETF.
It did. Grayscale's ETH distributed the first ever staking rewards to shareholders. It was about 8 cents per share. This is critical because it confirms U.S. ETFs can legally pass through that protocol yield to investors.
Which makes holding ETH in an ETF much more attractive. It narrows the gap with holding it yourself.
Exactly. It validates the whole structure.
Before we wrap up, let's touch on one more supply test we saw. The hyperliquid, the HYP token unlock. That was a huge chunk of tokens hitting the market.
It was a critical test of conviction.
Yeah.
You had about 12.5 million tokens worth around $330 million unlocked for core contributors. And the price showed immediate resilience. It actually rose a bit.
So what stopped that massive supply from just crushing the price?
On-chain data showed serious whale conviction. There was a visible 5.5 million USDC buy wall sitting right at the $24 support level. That heavy defense line suggests big holders were just waiting to absorb any sell pressure.
Which brings us full circle, back to conviction. All this data, the record ETF flows, the corporate buying, the infrastructure maturation, the geopolitical scarcity, it all supports the thesis that we are entering a super cycle dynamic here in Q1 2026.
That's the summary. The flows are execution, not just anticipation. The infrastructure plays are maturing into utilities. And that $95,000 level remains the critical tactical barrier. Once that's breached, it could open the door to six figures very quickly.
So before we close this out, you mentioned an evolution in how corporate treasuries are managed. Give us the final provocative thought we should be mulling over.
So while we focused on the big corporate buying, the next phase is the active on-chain management of those assets. We're now seeing public companies like DeFi Development Corp partnering with protocols like Hilo to actually manage their treasury assets on-chain to generate yield.
So public company finance plugging directly into DeFi protocol.
Yes, it dramatically increases efficiency and yield, but it also introduces new and very complex smart contract risks directly to public equity holders. And they might not even know their balance sheet is interacting with DeFi. That integration and its risks is something we're thinking about as this all gets deeper.
A fascinating new layer of risk for traditional equities. Thank you for guiding us through this unprecedented confluence of data. This has been the deep dive.